Welcome to lesson 1. If you haven't seen the introduction already, go watch it first. But this is the Foundations of Investing course. The first lesson, I'm going to ask you a strange question at the start. I want you to give me the answer, and then I'm going to talk you through the quiet problem of keeping cash. So the strange question is on the first slide. What is your money actually for? So we'll go through it in a minute. The quiet problem is inflation. Most people's answer to that question is being undermined by that something that they don't notice, which is inflation. So I will show you on a calculator. There's a calculator on my website, so you can run it for yourself. I will show you the effect it's having on your money. I'm Andrew. Let's get into it. Right, the question first. What is your money for? Strange place to start a course on investing, I know, but it's the most important question in the whole thing. If you ask people and you push hard enough, most people give the same kind of answer. Security, choice, time. Not having to worry as much as if you didn't have this resource, that luxury of having that resource. You can have a nicer holiday. You can spoil your kids. You can leave work when you'd like to, not when you have to. Almost nobody says a number. The number's just the means. It's because it's starting here that makes investing interesting. For its own sake, it's a tool for something to get. It's a tool to get you from where you are now to where you want to be. Keep that somewhere in mind through every lesson, because the mechanics will make a lot more sense if you do. Now, the quiet problem: cash is not safe. It feels safe, and that feeling is what makes it so dangerous. Here's what you see when you've got money in a savings account. You might put 10 grand in. A year later, it says 10 grand, maybe 10,200 with interest, whatever. The number is stable. Nothing scary has happened to that number. But here's what you don't see in the same view: is the price of everything else around you has gone up. That could be coffee, petrol, rent, insurance, the weekly shop, everything. School trips, eating out. Your pound bought less than it did a year ago. The number stayed still. That buying power has reduced. So let me make it a bit more concrete. £10,000 in cash, untouched. If inflation averages 3% a year, which is not out of this world, after 10 years, that same £10,000 buys you about 7,400 quid's worth of stuff in today's money. After 25 years, under £5,000 of buying power, less than half what you started with. The number on the screen, the £10,000 didn't move, but the money quietly halved. It's slow, it's invisible, and it's why doing nothing with your savings is eventually a decision that's going to cost you. Doing nothing has a cost. Okay, so cash is leaky. What's the alternative? Well, you've got saving and you've got investing. They do two completely different jobs, and we will talk about them throughout this course. Saving is money in cash, and it's for the short term. Available whenever, it's liquid, it's quick, number doesn't bounce around. Its job is to be there when you need it. The emergency boiler, it could be a car, a holiday, the few £1,000 problem that turns up out of nowhere. The time horizon for this should be weeks to years, not decades. Investing is different. Money puts the money to work in real assets such as shares, bonds, and property. Again, this is in a later lesson. It's in lesson 4. The number moves around. It's very volatile. Some year it drops, sometimes by a lot. Its job is to grow ahead of inflation over long stretches of time. Ideally, 7 years or more is the sweet spot. People mix these up. They invest money they'll need every month. They save money they won't be touching for 30 years. These mistakes cost you in the long run. Quick look at what you can actually keep after inflation over the long run. These are real returns. The real means net of inflation. Cash, about 0.5% real. This is if it's in a high interest cash account. Roughly inflation, it's sometimes below that. UK gilts, about 1.5%. Property, about 4%, a real return. That's blending the rental income and the price growth together. Global shares, about 5%. The highest, also the bumpiest, the most volatile, the most uncomfortable journey. These are long run averages, not single years. They are over decades. Past performance isn't a guide to the future, but the relative ranking, cash lowest, shares fastest, has been remarkably consistent across modern history. Project these numbers forward. £10,000 untouched in 10 years is worth roughly 10.5 grand in real terms. 25 years later, about 11,000. Barely moved. Same 10,000 in property, 10 years gets you to about 15 grand of buying power. This is real. This is like your buying power after inflation has eroded it. And 25 years, closer to 27. Same £10,000 in global shares, 10 years to about 16 grand, 25 years to about 34. The same money, the same amount of money, had the same start, they had different jobs. Wildly different jobs, wildly different endpoint. And shares is the most volatile journey of them all. We'll deal with the bumpiness in another lesson. So, quick pause to demystify what these, where these returns actually come from. Investment returns aren't a trick; they're not magic. When you invest, your money is going to work in the real economy. Companies grow, and as they grow, they sell more, charge more, and they become more profitable over decades. As a owner, as a shareholder, you share in that growth. Companies can pay you, profitable ones often issue a dividend, so they'll give you a portion of cash for holding your shares. Reinvested, these dividends quietly compound into a huge chunk of your long-term return. Borrowers pay interest. Bonds you own pay interest. Property you own pays rent. Real economic activity producing real income that comes back to you. There's nothing mystical, and it's not just magic tricks. It's productive economics. It's slowly making people who hold real assets better off. Here's a task I want you to do before the next lesson. And it's just one thing, one sentence, and you just write down on a piece of paper. Write down, what do you want your money to actually do for you? One sentence, as long as you can make it, not a number. I don't want you to write down £1 million, £10 million, £100 million. I don't want you to try and design a portfolio. I don't want you to try and design a strategy. I don't want you to design or target a specific retirement age. Just the reason why you want to have more money and what you want that more money to accomplish for you. What does it buy back into your life? Whether it's time. So though I don't want you setting a target retirement age. I want you, if it's time you want to buy back, write down, I want to retire earlier. If you want to get a new car, write down that you want to buy your dream car. Just write something down. Keep that sentence somewhere, because in the last lesson we'll build your one-page plan around it. So if you remember nothing else from this lesson, there's 3 things I want you to take away. Cash is not safe. Inflation will erode away at it. I've got 2 calculators on my website. Go plug some details into them, have a play with them, and you will see the impact of inflation and compound interest on your money. 2, save and invest. They're 2 different jobs. Saving is for soon, investing is for later. You're paying yourself later with every pound you invest. Mixing these up will cost you in so many ways. And then 3, have a reason. Have a reason to do what we're going to do. Have a reason to be in that volatile journey that is investing. And just keep this in mind. Doing nothing has a cost. Waiting has a cost. Everything you do will have a cost. So make sure you do it well and minimize that cost or benefit to you.